give a quick overview of what we've been doing. I'm not going to read all of these on this slide, but I will hit most of this as we go through it. It's been a phenomenal 2 years at Great Lakes. I had more boxes to put on here, but ran out of space. But again, I'll hit on most of these throughout the presentation. Let me start with who we are. Great Lakes is the largest U.S. dredging company. Been doing this for a very long time. Company was established in 1890. Largest not only in market share, by number of dredges as well. We mostly work as a government contractor. Our biggest customer is the U.S. Army Corps of Engineers, but we also work for state, local governments. We also work for private clients. We're doing a lot of LNG work right now. We are also moving into a new line of business. We are building a vessel to get into offshore energy. That's offshore wind and a couple of other businesses as well, and I'll get into that throughout the presentation. On the dredging side of business, there are three major type of projects that we do. The first one is capital. That is port deepenings, port widenings. As ships have gotten larger, all of the ports in the U.S. want to get deeper. They actually compete with each other, so when one gets deeper, they all want to get deeper. This is very complex work. There are not a lot of dredging companies that can do it, and you get paid accordingly. The margin on these type of projects are very, very good. This is Great Lakes bread and butter. We love these kind of jobs and typically do extremely well on them. The U.S. Gulf is going through a large deepening cycle right now, and that's what's driving almost half of our revenue coming from this segment. The next type of work is coastal protection. So this is the creating of beaches, but also the rebuilding of beaches. Natural erosion, storms come through. You need to rebuild these beaches or cities are underwater. So it's a steady stream of income for Great Lakes. And the last thing is maintenance. This business is the gift that keeps on giving. There is natural sediment that occurs, and a lot of these ports and waterways we have to go into periodically, sometimes annually, and just clean those up. Now, this type of work is not as complex. It is more competitive, and the margins of these three are the lowest. The last one I have on here is foreign. Right now, all of our vessels are in the U.S. because the U.S. market is extremely strong, but Great Lakes has a very long history of working internationally. We have boots on the ground in a number of areas. We monitor these markets, and if the right opportunity persists, we can deploy our assets overseas. I'm not going to get into all the specifics here. There are three different kind of dredges. One of the unique advantages that we have at Great Lakes, we have a number in all three. Each type is meant to do certain things better. And on projects, we have flexibility to move equipment in and out. So we can bring, if we have a large project, it's not unusual for us at various times to put all three types of these equipment on here. Most of our competitors don't have an array of all three of them. So we're just able to go in and out, be very efficient when we're executing projects. As I mentioned, we are the largest market share and number of dredges. We're sitting with 17 dredges today, double our next largest competitor. On average, we typically have in the mid 30%. This is showing 31. We're excluding from this the LNG market because that is the government market is a public market. The private work is not, so it's not included in the bid stats. I'll talk about it in a little bit, but we won 3 very large LNG projects. When you include that, this number gets closer to 40%, and it's a market share that we have year after year. As I mentioned, we are mostly a government contractor. Our largest customer is the U.S. Army Corps of Engineers. Again, as everybody has seen in the headlines, government has been operating under a continued resolution all of last year. There was a shutdown for the beginning of this fiscal year, and now we continue in a continued resolution. During a continued resolution, though, all government entities get access to prior year's budgets. The 2024 budget was a record budget for the Army Corps of Engineers. That's the budget that we're operating under now. It has been business as usual. Even during the shutdown, the work that we do is considered essential. All of our projects continued, payments continued. Infrastructure dredging, it truly is one of the bipartisan subjects, and under any administration, we have seen a lot of support. There had been 7 consecutive years of record budgets for the Army Corps of Engineers. In addition, a couple of years ago in 2023, a number of storms really decimated the East Coast. There was an additional $1.5 billion allocated to the rebuilding of those beaches. A lot of that work is being executed now, so another source of money coming for this large bid market. I do want to mention quickly WRDA. It's the Water Resource Development Act. This comes out every 2 years, and it's where they authorize studies of the next large project. So it's very important to us to see what's coming next. I want to specifically point to the WRDA 2022. That's when the New York Shipping Channel was authorized to begin the study. That's the next big deepening that's going to occur. So there's a number of them on the East Coast. This is going to be at least a $4.5 billion project starting towards the end of this decade and going well into the next one. Great Lakes played a big part of the last New York deepening, and our expectation is that we'll be there for a long time on this one. And then lastly, as I mentioned, over the last couple of years, there were 3 very large LNG projects that came out that we won. 2 of them we're executing right now. One of those 2, Rio Grande LNG, the largest project in Great Lakes history. We commenced that work in 23 and we'll continue that. In 24, we'll continue that well into next year. And then we recently were awarded Woodside, Louisiana LNG, and we will commence that early next year. Very, very good projects, all in excess of $100 million and very good margins. And it's really been very driving the results we've seen over the last couple of years and will continue to drive next year as we execute more of this LNG work. I mentioned the East Coast deepening cycle that's coming. So the Gulf current deepening cycle is coming to an end. There's a few more and we're executing them, but that'll start winding down in the next year to 2. But right after that, the East Coast is going to start their deepening cycle. I mentioned New York, but you can see up and down the East Coast, there's a number of them that are slated to begin in the next couple of years. So we think the backlog profile that we have had, very heavy on the capital work, when these move forward, and it appears that'll happen starting in 2027, we should be able to continue that same mix of work, very heavy on the capital, higher margin type of projects. So as I mentioned, we typically win 35-ish or so % every year, and last year was no exception. We have been sitting at close to $1 billion of backlog for the last year and a half or so. Just as important, if not more important, is the construct of the backlog. So if you look at that top chart there, over 78% of our current backlog are on these higher margin capital projects. The coastal protection projects also very, very good margins, make up another 15%. So over 90% of our current backlog is sitting on these higher margin projects. I know that bottom chart's a little hard to read, but you can see the colors. Those are the major awards that were awarded in 24. So that's the work we're executing now and we'll start executing next year as well. This does not include the LNG because those were actually awarded in 23. But of the ones in 24, we won 3 of the top 4 and 6 of the top 9 projects. Again, very good projects, and those are the ones that are being executed currently. I do want to spend a minute on this. So we have really embraced technology into the dredging side. And we've been doing this a long time. Our guys are very, very good, but we've been able to now utilize what we call the Remote Operations Center. So this is sitting in our Houston corporate headquarters. We have sensors on every dredge. We can monitor what's going on the dredges 24/7, 365, and look for improvements. Our guys, it's manned with a bunch of subject matter experts in the room. They're looking at production. They see something that think maybe can be better. They can communicate with the dredge, hey, try doing this. We can see real time the impact it has. This is in its infancy now. There's a lot of possibilities here. We're already seeing a big boost on this. Our contracts are mostly fixed price contracts. The revenue is what it is. The performance is what drives margin. We are seeing we're getting jobs done quicker. Revenue is what it is. That just helps the bottom line. So there's a lot more possibilities for us with this Remote Operations Center, but a really good embrace of technology into the dredging world. We are in the very, very late innings of an extensive new build program. Over the last handful of years, we had a $550 million new build program. We built 2 new dredges. Both we have taken delivery of, both hopper dredges. So those are the ships. They're self-moving. Very lucrative market. We have the largest and the youngest hopper fleet in the United States. The Galveston Island and Amelia Island, both working, doing extremely well. We also invested in a number of support equipment. We're also building our last new build right now, the Acadia. That is not a dredge. That is to service the offshore energy business. That's the growth platform for this company. We'll take delivery of the vessel at the end of next year, and she will go straight to work. So let me talk a little about offshore energy. So one of the markets that we go after is offshore wind. The vessel we're building, it's the only Jones Act compliant subsea rock installation vessel in the world. It's a vessel that lays rock on the seafloor over anything that needs scour protection. So on a wind farm, around the monopiles you lay rock, and around the cables that connect it. So we have the only Jones Act one of its kind. We do have 2 projects in the US. They're fully permitted. They're under construction now, so they will go forward. As soon as we take delivery, we go straight onto Equinor's Empire Wind 1 project. From there, we go to Ørsted's Sunrise Wind project. And then there is not much in the upcoming years in the United States, but it's a big ocean. There's a lot of offshore wind activity in Europe. We've been planning for the possibility of a slowdown in the US for quite some time. We have boots on the ground in Europe. We have a London Great Lakes office in Europe, and we are making a lot of progress to get utilization, not only in 27 and 28, in a much more established US offshore wind market. So we'll take the Acadia at the end of 26 to Europe. We'll work it there for a few years. We truly believe offshore wind will come back to the United States. Likely 29 or 30. We'll work it in Europe until then, and then we'll bring her back. The chart on the bottom left just shows the demand internationally for offshore wind. There will be a lot of growth. The horizontal bars is the world supply of vessels like the Acadia. The lower one, the orange one, is the type of vessel that we have. There's only 6 or 7 of these in the world. So a lot of demand for this type of vessel. We will work it. Once we come back to the US, we have an even greater advantage being the only Jones Act vessel of its kind. One thing, as we've been in Europe the last couple of years, we discovered it's a much broader market than just offshore wind. As I said, this puts rock over anything that needs scour protection. Cables. We've seen incidents in the news of anchors being dragged over power and telecommunication cables. You throw rock over it, that's not going to happen. Same with oil and gas pipeline. Another layer of protection, you put rock over it, you can protect it. So while offshore wind is going to be a big part of our offshore energy platform, there are other markets that we're pursuing as well. Let's get into some of the numbers. As I mentioned, backlog is the driver of this business. We've been sitting at this $1 billion for quite some time, and as I mentioned, mostly in this capital work. So this is just a good indicator of what the next 12 months are going to look like. We have the work in backlog. We'll start executing those and continue to win work to fill this pipeline up. Looking so far this year compared to last year was the second best year in company history. And as you can see, for the first 3 quarters of this year, we're blowing past that. Top line, margins, EBITDA, and we said on the last conference call, and I'm very comfortable repeating it today, this will be the best year in company history by quite a long shot. Prior to this year, $151 million of EBITDA was the record. We were at 127 through the 3rd quarter. And fortunately for us, with the backlog we have, there's no reason to think that this is going to stop anytime soon. Just to show some historical and what we have done over the last few years, on the left, revenue has grown. That hatched line is the trailing 12 month, and the one right next to it is just through the first 3 quarters of the year. If you look on the right, like I said, we're coming to the very end of a very large new build program, so CapEx will start going down materially starting next year once we take delivery of the Acadia. And then you can see what the EBITDA profile and growth has been over the years. Again, you look at that hatch line, 168 million, trailing 12 months, which would be by far the record if that was a standalone year. But again, very comfortable. This will be the best year in company history. Turning to the balance sheet, just a couple of months ago, we did upsize our revolver to $430 million and did a fresh 5 years. So now we extended it out till the end of 2030 with enhanced terms. We got a 60 basis point reduction off of the legacy ABL that we had. At the same time, we took out a $100 million second lien piece of paper that we had, immediately put it on the revolver, so liquidity neutral, upsize the revolver $100 million, put the $100 million directly on there. That saves $6 million of interest a year. It's at a 600 basis point decrease. And now that it's on the revolver, we have the flexibility of paying that down. And since the end of October, with the cash flow we have coming in, we've already paid off $25 million of it. So that's the priority now. The cash we're going to be earning, we will delever, we'll pay off this revolver, and then balance sheet's already in really, really good shape, and we'll get it even better. So looking at some of the debt metrics, this is at the end of the third quarter. Again, liquidity at the time of close to $300 million. Now with the pay down that we had, it's over $300 million. Despite writing some very large checks for this new build program, we're still significantly cash flow positive this year at $52 million. We've paid over $100 million on the CapEx side. And again, in the middle of a very extensive new build program, we've gotten our leverage ratio down below 2.5, and that'll keep improving. We have no maturities until 2029. Our weighted average interest rate is under 6%. So I said balance sheet in really, really good shape. So now that the new build program is coming to an end, our focus is on cash flow. So here's just an illustrative example of what we expect to see on the other side of the new build program. So I'm just going to use the trailing 12-month EBITDA as a proxy for cash flow. Once we're done with the new build, our maintenance CapEx is usually in about the $25 million range. Today, cash interest is $24 million, but as I said, I expect that to start going down as we continue to pay down the revolver. Even though we have income, we have a number of NOLs and tax credits, so we don't anticipate being a federal tax cash payer until at least 2028, so I don't have a tax burden. You can see what the cash flow is. So we invested for a reason over the last handful of years. We've got a very young, nimble fleet, and now it's time to start reaping the cash benefits from that. And a few things in the appendix I won't go through. It's posted on our website. But how'd I do on time, Joe? I think I left you a few minutes if there's any questions.
Questions? You said the East Coast. Is that a lot of intercoastal?
Now, this is actually going to be the ports themselves. So again, so allowing the bigger ships to come in for the importing and exporting.
Not in a coastal business?
Now, we typically focus on the blue water stuff.
Okay. And the rocks you lay, does that come from your dredging?
We have to get it manufactured from a quarry. It's very specific type of rock that you need for this scour protection. And each wind developer will set the specifications of what they want, and then we contract with a quarry to produce that type of rock.
What's your dividend paying philosophy?
I'm sorry?
Dividend paying philosophy?
Yeah, so company has not paid a dividend in quite some time. As I said, the focus over the last few years has been, one, get through the new build program, and then two, pay down debt. That being said, earlier this year, coming off the second best year in company history, and we knew this year was going to be extremely strong, we announced our year-end earnings, and our stock went down into the $8 range. We quickly convened the board, said there's a huge disconnect right now between our share price and where we know we should be valued. We very quickly put a buyback program in place. We executed on it right away. For $11 million, we bought back 2% of the company. Today, the stock's trading at $13, so I think the market caught up. So that program is still in place. Again, priority now is to delever, but if we see another disconnect, we're definitely not shy. So, I think you mentioned dividends, but again, we thought that in the scenario, at least that we had, a buyback was much more attractive. Mhm.
In general, is the relative attractiveness of the property of the projects similar to the US? Or in general, how would you kind of put side by side the actual attractiveness of business opportunities outside of the country versus regular funds?
Yeah. So the U.S. is extremely steady. We know what we're getting into here, and again, we've done a lot of foreign work. We've done a lot of work in the Middle East. That really seems to go with the price of oil. When oil is high, there's a lot more attractive projects. A lot of private work that we've done, and that's what we've done. Especially still have an office in Bahrain. We keep focus on that market, but as long as this U.S. market is this lucrative, I imagine we're gonna have all of our vessels here, but we're always looking for that opportunity. This is a margin game for us, and we'll go wherever we can get the best margins.
So give me an idea what the size of the market is in Europe that is even there for wind looking at?
Yeah, so wind, there are a number. I would say it's an established business. They've been doing this for 15 years. Right now they have globally, there is looking to get to 200 gigawatts. Right now Europe is sitting well below that. So, okay, thank you. So there's a huge wind opportunity, but the other one that I said we're looking at is the telecommunication cables and the oil and gas. There's also an Asian market as well that we're starting to explore as well. So from a wind standpoint, a much more established market. One thing I'll mention though, in the U.S. on the Acadia, we started signing contracts 4 years ago, only because we were the only game in town. If somebody wanted a Jones Act vessel, they need to do. The foreign market, since it is much more mature, it works a little more like a spot market. So the fact that, we're talking 27 utilization and we're getting it to 26, that's how this business works. So usually don't have the same long-term visibility, at least that we saw here in the US. We're talking 12 to 18 months out is typically when you start looking to contract stuff.
So what's the size of a contract in Europe? What's the dollar amount?
Yeah, so again, depending on the wind farm, we call full utilization somewhere around 240, 260 days. That is usually made up of 1 or 2 contracts, again, depending on the size of the wind farm. Depending on where you're working, and as you can imagine, not all projects are created equal. We said the revenue capacity, in a fully utilized year for the Acadia is somewhere in the $100, $120 million range, just depending on the project.
So one of the things that can impact, especially on a quarterly basis, is dry docks. You had a fair number this year. What's it look like in 26, the dry docking schedule?
Yeah, and thanks for bringing that up, Joe. I wanted to, but I was afraid you'd yell at me if I didn't get the question. So these vessels are required to go into regulatory dry docking. 2025, despite it going to be a record year, this is the heaviest dry docking year we've had in a while. So you're required to bring the vessels in, do certain repairs, get certain inspection. We had 7.5, because one will go over the year in 2025. The good news is when you have a heavy dry dock year, it's usually followed by a lighter dry dock year. So right now we have one in dry dock that will continue into next year for a month or so, and we have 3 others planned right now. Some of these we have a little flexibility to move to the left or right. So right now we look at it, we'll have 3.5 versus the 7-ish that we had in 2025.
Competition, you're winning most of your contracts. Like, what's the competition? A lot of them smaller? I'm not familiar with the dredging so much. Is there a lot of smaller pieces, local pieces?
Yeah, so, and I won't try to find the slide, but yeah, if you look at it, we have, call it a 35% market share.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then ChannelCheck truly is your trade. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series lunches, and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since ChannelCheck is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why ChannelCheck is North America's leading source of research on the companies that just may change the world.